Listen to me very carefully because what I am about to share with you is not a theory, it is not hopium, it is not speculation, it is cold, hard, verified, documented data that Wall Street does not want you to understand, that the mainstream financial media will not explain to you, and that the people who are managing the system desperately hope you never piece together on your own. And today, right now, in real time, silver is making history, not the kind of history that gets a 30-second mention on the evening news between a celebrity story and a weather forecast, the kind of history that 5 years from now, people will look back on and say, that was the moment, that was the turning point, that was the window, and most people missed it. So let's start with what has already happened, because the facts alone are extraordinary. Silver opened the year 2025 at $28.92 per ounce. By the time 2025 closed, silver was trading above $72 per ounce, a gain of 147% in a single calendar year, 147% in a single calendar year, 147% in 12 months. That shattered every institutional forecast on the planet. UBS had a target in the mid-50s. Bank of America was talking about $65. JP Morgan was projecting an average of $81 for all of 2026. Every single major bank was wrong to the downside. Why? Because their models are built on the assumption that markets are linear, that history rhymes in predictable, smooth patterns, and that the rules that govern silver for the past 30 years still apply today. They do not. And that is the entire story. Let me take you through the 4 forces that have converged simultaneously, something that has never happened before in the recorded history of the silver market, and explain to you why this rally is not over, why it is not a bubble, and why the word unstoppable is not hyperbole. It is a description of the physics of the situation. The first force is the supply deficit, and it is the foundation of everything. The global silver market has now run a structural deficit for 5 consecutive years, 5 years in a row. Every single year since 2021, the world has consumed more silver than it has produced. The Silver Institute and Metals Focus, the 2 most credible research bodies in the precious metals space, confirm that the cumulative shortfall between 2021 and 2025 totals approximately 820 million ounces. To put that in perspective, global mine production runs at roughly 820 to 835 million ounces per year. That means in 5 years, the world has consumed the equivalent of an entire year of global silver mining production more than it produced. That silver had to come from somewhere. It came from the vaults, it came from above-ground stockpiles, it came from comex warehouses, from London Bullion Market Association vaults, from Shanghai Exchange inventories, and those inventories have been absolutely devastated. COMEX registered silver inventories. The silver that is actually available for physical delivery on the futures exchange dropped over 70% from their peak in March of 2020 when they held 346 million ounces down to just 82 million ounces. That is a collapse of physical deliverable supply at the very exchange where the price of silver is ostensibly discovered. Meanwhile, in London, LBMA vault holdings have fallen 40%. In Shanghai, inventories have hit decade lows. And silver lease rates, the cost of borrowing silver for short periods, which in a normal market with ample supply sits at a fraction of a percent, have exploded to 8% annualized in January 2026. Think about what that means. Sophisticated institutions are willing to pay 8% per year just to borrow silver for a short period because they cannot find enough physical metal. Some reports from late 2025 showed lease rates spiking as high as 39% annualized during acute market stress events. This is not a functioning, well-supplied market. This is a market that is physically, structurally broken, and the price is only beginning to reflect it. The 2025 deficit alone was catastrophic. Total global silver demand in 2025 hit an estimated 1.24 billion ounces. Total supply from all mining and recycling combined came in around 1.01 billion ounces. Total supply from all mining and recycling combined came in around 1.01 billion ounces. That leaves a single-year shortfall of over 230 million ounces, more than the entire annual production output of Mexico, the world's largest silver-producing country. And Metals Focus, when they include ETF inflows in the calculation, puts the real market balance shortfall for 2025 at a record-breaking 295 million ounces, the deepest silver supply deficit ever recorded in history. And 2026 is expected to be worse, with the annual deficit projected to reach approximately 200 million ounces, even under conservative demand assumptions. Now, here is the critical piece that most analysts miss. Unlike copper, unlike nickel, unlike most commodities where a higher price signals to miners to open new projects and flood the market with fresh supply, silver cannot do that. 75 to 80% of all silver produced in the world comes as a byproduct of mining for other metals. Copper mines, zinc mines, lead mines, gold mines, they produce silver as an accidental output of their primary operation. When silver prices go up, those mines do not suddenly start producing more silver. They produce more when base metal economics justify it and not before. Primary silver mines, the ones that exist solely to mine silver, account for only 20 to 25% of global silver supply. And new mining projects, if you start one today, take 8 to 12 years to bring to production. The supply response is physically, geologically, economically impossible to execute in the short or medium term. The deficit will persist. This is not a guess. It is the constraint of geology and economics, and no amount of central bank policy or government intervention can change how long it takes to build a mine. The second force driving silver to triple digits is industrial demand, and this is where silver's story becomes genuinely unique in the history of any commodity. Silver is no longer just a monetary metal, no longer just a jewelry input, no longer just the poor man's gold that follows gold around like a shadow. Silver has become the foundational industrial material of the 21st century economy, and I mean that with scientific precision. Silver has the highest electrical conductivity of any element on the periodic table. It has the highest thermal conductivity of any metal. It has natural antimicrobial properties, and it cannot, in most applications, be replaced with anything cheaper. You cannot build the green energy transition without silver. You cannot build the AI revolution without silver. You cannot build the electric vehicle infrastructure without silver. And the world has decided it is doing all three at the same time. The Silver Institute, working with Oxford Economics, published a landmark report in December 2025 titled Silver, the Next Generation Metal, and what it shows is astonishing. Solar photovoltaic manufacturers consumed over 25% of the entire global annual silver supply in 2024, and demand surged again in 2025. The International Energy Agency projects solar capacity will nearly quadruple by 2030. By 2050, cumulative solar demand for silver could equal 85 to 98% of all known silver reserves in the ground today. Electric vehicle demand for silver jumped approximately 20% in 2025 alone, driven by sensors, high-voltage wiring, onboard charging systems, and the parallel expansion of EV charging infrastructure. EV vehicles are expected to overtake internal combustion vehicles as the primary source of automotive silver demand by 2027 and account for 59% of the automotive silver market by 2031. And then there is artificial intelligence. Data centers, the physical infrastructure that runs cloud computing, stores global data, and powers AI systems, are consuming silver at a scale that barely anyone is tracking. The Silver Institute estimates that global IT power capacity grew 53 times between 2000 and 2025, from under 1 gigawatt to nearly 50 gigawatts. AI is accelerating that trajectory. One Seeking Alpha analysis estimated that U.S. and Chinese data centers alone consumed approximately 350 million ounces of silver in 2025, more than 50% of total annual mine production. For the solar panel maker, for the EV manufacturer, for the hyperscaler building out the AI data center, silver is not optional. It is not a discretionary purchase. It represents a small fraction of their total production costs, so even if the price doubles or triples, they will pay it. They have no alternative. Running out of silver is not an option for any of them. This is what economists call price inelastic demand, demand that continues regardless of price, and it is one of the most powerful forces in commodity markets. The third force is geopolitical, and it changed the entire global silver equation in a single policy announcement. At the start of 2026, China imposed strict export controls on silver. Effective January 1st, 2026, all silver exports from China now require explicit government approval. Only 44 companies have been authorized to export silver, and they must meet strict minimum production thresholds and financial capacity requirements. This is an existential change in the supply landscape. While China accounts for only about 13% of global silver mining, it dominates 60 to 70% of global silver refining. China is not just a producer, it is the world's refining hub, and it has just told the rest of the world you can no longer rely on Chinese refined silver to plug your deficits. In the words of analysts at FX Street, China has elevated silver from a widely traded industrial metal to a strategic resource, placing it in the same category as rare earths, where geopolitical control of supply becomes a weapon in great power competition. The physical markets responded immediately. In Shanghai, physical silver briefly traded above $80 per ounce, while comex futures were still anchored far lower, creating an extraordinary price divergence between paper silver and real silver. The gap between the paper market and the physical market is the fault line along which the entire silver price structure may soon be forced to reset. And that is the fourth force, the monetary force, the debasement force, the reason that every currency crisis in recorded human history has ended with people running to silver and gold. The United States national debt is now beyond $36 trillion and growing by more than $1 trillion every 100 days. The Federal Reserve cut interest rates in 2025 and initiated $40 billion per month in Treasury bill purchases in December, what some analysts called a return to quantitative easing under a different name. Temporary weaker dollar, lower real interest rates, and the prospect of sustained monetary expansion are the precise macro conditions under which silver and gold have historically performed best. The so-called debasement trade, the rotation out of paper financial assets and into hard assets that cannot be printed, is happening globally, not just in the United States. China's renminbi has fallen nearly 20% in real effective exchange rate terms since early 2022, pushing Chinese households and institutions into precious metals as a store of value. India became the world's largest importer of refined silver in 2025, with imports estimated at $9.2 billion, a 44% increase over the prior year. Silver ETF inflows surged 40% in 2025, absorbing 134 million ounces of additional physical metal, further draining available supply. And silver-backed ETF holdings globally have now reached record levels even as vault inventories collapse. The gold-to-silver ratio tells you everything you need to know about how undervalued silver remains even after its historic rally. Historically, the ratio between gold and silver prices has averaged around 65 or 66 to 1 since 1971. In nature, silver is roughly 17.5 times more abundant than gold in the Earth's crust, which historically anchored the monetary ratio near 15 or 16 to 1 for centuries. When this ratio has been historically high, when gold is very expensive relative to silver, silver has always eventually violently mean reverted Today, even after silver's 147% surge in 2025, the gold to silver ratio has only come down to approximately 50 to 1 point, with gold above $5,000 per ounce, a return to the historical 33 to 35 range. Not even the deep monetary ratio, just a partial normalization would put silver above $142 per ounce. A return to 20 to 1, which occurred during the 1980 peak of the previous precious metals bull market, with gold at current levels, would imply silver above $250 per ounce. Now, let me be precise about where we are right now. Today, February 28th, 2026, silver crossed $100 per ounce in January 2026, a milestone that technically represents the first all-time high in nominal terms, a level it had never touched in its entire trading history. After touching a high of $100.78, the metal pulled back and is now trading in the high 80s to low 90s as of this week. That pullback is the exact kind of consolidation that the most bullish analysts expected and welcomed, because it is shaking out weak hands before the next leg higher. Analysts at Dever Group project silver at $200 per ounce by end of 2026. Jim Rickards has forecast $200 silver in 2026. Gold Silver's lead analyst Alan Hibbard has publicly stated he expects silver to increase by more than $100 per ounce from its starting level this year, implying $175 or higher. First Majestic CEO Keith Neumeyer, who has held a 100-plus silver target for nearly a decade and has now been proven right, is standing by his $130 price target and believes it is conservative. The Allegiance Gold team has put a near-term window of $100 to $144, and one technical analyst firm, after silver broke its cup and handle formation on the multi-decade chart, has published a target structure pointing to $300 or beyond by the end of the decade. But here is the most important thing I want you to understand. This is not about any one analyst's target. This is not about who has the boldest prediction or the most dramatic chart. This is about the fundamental, irreversible, structural reality that the world has built an entire technological civilization that requires silver, and the world does not have enough silver to supply it. 5 consecutive years of supply deficits, 820 million cumulative ounces drained from above-ground inventories, COMEX registered supply down 70% from its peak, China restricting exports of refined silver, industrial demand from solar, EVs, AI, and data centers growing at double-digit rates annually, governments that have sold every ounce of their strategic silver reserves. The United States sold its last silver from the National Defense Stockpile in 2019 and now have nothing left to deploy in a crisis. And a global monetary system under pressure from record debt levels, currency debasement, and a great rotation out of paper and into physical hard assets. The question is not whether silver reaches triple digits. Silver has already been above $100 per ounce. The question is where this structural repricing ends. And the honest answer, based on the data, is that nobody knows the ceiling, because nobody has ever lived through a silver market that looked exactly like this one. What we know is this: the deficit is real. The industrial demand is real. The monetary pressure is real. The geopolitical supply constraints are real. And the above-ground inventory drawdown is real and mathematically finite. At some point, the physical market price discovery mechanism wins. At some point, the paper futures exchanges where silver can be shorted by institutions that have never owned a single physical ounce lose their grip on the price narrative. That moment may already be underway. If you are sitting on the sidelines waiting for confirmation, understand what you are waiting for. You are waiting for the price to go higher to feel comfortable buying it, which is the opposite of how wealth is built. The people who protect their purchasing power, who preserve their financial future through periods of monetary instability, are not the people who wait for CNBC to validate their decision. They are the people who read the data, understand the fundamentals, and act before the crowd arrives. Every single piece of data I have shared with you today is publicly available, verifiable, and documented by the Silver Institute, Metals Focus, COMEX, LBMA, JP Morgan, UBS, Bank of America, Fitch Solutions, BNP Paribas, and the most credible precious metals research institutions on the planet. Silver is not going back to $30. The world that existed when silver was at $30 is gone. The supply that made $30 silver possible has been consumed. The inventories that made $30 silver sustainable have been drained. The geopolitical conditions that allowed global silver to trade freely and transparently have changed. We are living through a structural repricing of one of the most important metals on Earth at the exact moment in history when the world needs it more than it ever has and has less of it available than at any point in decades. That is not a trade, that is a reality. And the only question left is how you position yourself before the next chapter of this story is written. This is the window. The data says so, the fundamentals say so, the mathematics of supply and demand say so, and history, every time this set of conditions has appeared in any market, in any era, says so. Silver's rally is not unstoppable because of hope. It is unstoppable because of physics, and physics does not negotiate.